This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning John Rubino, well-known author and publisher of the website dollarcollapse.com. Good morning, John, and welcome back to Macro Analytics.
Morning, Gord. Nice to be back.
John, it's always nice to have you back, and I'm actually excited about some of the subjects we're going to talk about here this morning, as usual. But I'd like to continue with the discussion we had on your last visit with us on moral hazard, unintended consequences, and dysfunctional capital markets. Frankly, we just simply ran out of time on this subject because it's such a large subject, and I'm sure we're going to run out of time again this morning, so I just want to get right at it. I thought we'd pick up by talking about some of the examples and specifically what the ramifications are. We'll talk about moral hazard, then talk about unintended consequences, and then tie it together, if we have time, with effectively what is going on here with monetary malpractice. The first one I have up is on moral hazard. Maybe you want to take it from there.
There's a famous quote from John Maynard Keynes about how currency debasement unleashes all the hidden forces of economic law on the side of destruction. And we're living through a period where that's becoming increasingly true right now. And I think the place to start that really illustrates this process is with what happens to our big banks during a period when money is extremely easy. Because the system we've set up is one in which the Federal Reserve basically dumps new reserves onto bank balance sheets when the government is overspending and needs to finance that overspending. And so the banks have these reserves and have to do something with them. But picture what it's like if you're a good banker. Somebody who's already lent all the money that you can lend to good credits. In other words, you've given money to everybody who deserves a loan, and yet the Federal Reserve is still dumping new reserves onto your balance sheet. So you have a choice of either just holding onto those reserves and not lending money to people who don't deserve to get loans, and then reporting lower earnings because you're not generating fees from all the new lending that you could be doing. In which case you lose out to the Angelo Mazzulos and Jamie Dimons of the world. You look stupid next to them and you get fired, or just going with the flow and taking those reserves and lending them to whoever shows up. Anybody with a heartbeat and a steady job gets money. And so then you become corrupted by this process. You're either out of the business or you become a bad banker who's just taking on excessive risk because that's the only way to keep your job. And that's what happens to our banking system. That's what has happened to our banking system. And in effect, it turns our banks into hedge funds where they're gambling with the money that they should be lending out in a very prudent way. And so we end up with a corrupt banking system, but we also end up with extremely powerful bankers. They're making huge amounts of money on the government, on the money that the government is giving them essentially for free, and they, in effect, take over the economy and the government, and that's what we're seeing now. So it's an across the board corruption of the system, and the source of it is easy money. Now, what's happened lately is that we did have a near-death experience. That debt, almost did destroy the system in 2009. But the banks were able to hold the system hostage and say, all right, unless you save us, unless taxpayers cover our losses, then the whole global financial system is going to collapse. So, we caved because the government doesn't want to see that happen. And now we've designated these banks basically too big to fail. In other words, they can do anything they want to, and we're going to pick up the tab. And so now they've got this too big to fail status, which allows them to borrow money even more cheaply than before, and much more cheaply than well-run local banks, for instance. So the big banks are now squeezing the little guys out of the mortgage market and out of other lucrative markets, and they're getting even bigger. So the process, far from being stopped in 2009 when everything fell apart, it's actually accelerating. The banks are getting bigger and more powerful, and their tentacles are extending further and further. And so what we've got now is a financial oligarchy in which the banks and the government and the military industrial complex have merged into one big organization. So now Ben Bernanke and Jamie Dimon and Barack Obama and their counterparts in Europe and to an extent Asia are all part of one organization that has stopped serving its original clients and is now basically bent on getting bigger and more powerful. And that's as all big bureaucracies do. Their organizational imperative has switched from serving clients to expanding their own power. And that's where we are now. And the final result of all this is a police state, in effect, in which the system no longer pays any attention to the Bill of Rights, and technology is used in the service of suppressing dissent while we continue to destroy the fiat currencies of the world. And that's where we are now. And, it's a terrifying prospect, but it's one that is completely predictable for someone who understands how fiat currencies and easy money works. The Austrian economists got this right decades and decades ago. The most famous book in that genre is The Road to Serfdom. In other words, you put governments in charge of the printing press, and you end up being slaves to the monster that creates. And we're very close to that point right now in our history.
John, I would argue that we're not only close to it, we're in full war cry, moving along that path. And later this week, I'm really looking forward. We're going to pick up on exactly that subject and how our constitutional rights are now being threatened, and they were perfectly predictable on this road, on this process, and others have spelled that out. You've made a number of really important points, and one of the things I would challenge, not in what you said, but challenge in the road that we put ourselves onto, is we don't have something that's too big to fail right now. What we have is things that are too big to exist, and we have failed really to learn the lessons that we learned when we brought in the antitrust laws and the monopoly laws, and that was the antitrust laws with the Sherman Act, as the Canadians had the Combines Act, but these were laws that stopped organizations from being too large because it didn't allow competition to be fair. And in fact, what was happening is the market became uncompetitive because they were too big. And the failure here is to really have exercised existing laws. And when we had the financial crisis, we made the choice in the hurried moment, which I'm greatly troubled by, not to put these banks into a position where we broke them up. And the fear was the system would collapse. And that's a fallacy. Because General Motors we put into receivership, Fannie Mae we put into conservatorship, and we could have taken these banks without closing a single door, without stopping one ATM transaction, and simply had the government guarantee as debtor in possession as we broke them up, taken from weak hands and put them in stronger hands, and exercised this quite well, and it would have been dramatically cheaper for the taxpayer. Would you agree with my observation there, John?
Totally. I'd take it even further. If, let's say, Goldman Sachs disappeared tomorrow, would that change the number of factories in the U.S. or the number of biotech research labs or the number of hospitals? Not at all. Our physical wealth wouldn't change in the least if the financial, quote unquote, wealth of these big banks disappeared. They're not real. And so the idea that they are able to hold the global financial system hostage might be a mirage, and it might be that obviously some disruptions would happen if they disappeared, but we would still have all the roads and schools and bridges and hospitals and factories that we had the day before.
I love your question, and I would answer it, we'd be better off. And I'm not trying to pick on Goldman Sachs, but an example of what's happened today is we're using our capital, not investing it for productive assets. I'll call that investing it in the top line growth. so that you take your balance sheet and you expand it, and you, by taking that money or debt, you buy assets that produce real goods, real services that in fact then flow to the bottom line on the P&L as net earnings. And that's traditionally what we've done. We've stopped doing that. What's happened now is we're playing a bottom line game, so that on the balance sheet what we do is we move liabilities, debt off the balance sheet so that we have incredible amounts of leverage. We then are working on the P&L further down below the operating line as investment income, so that the money and the profit which shows up on the bottom line is not in productive assets. It's in the manipulation of financial assets. To some degree that is healthy, but we've gone to such a level, and I was noticing that the head of the Chinese investment bank, he made it very clear. He says the United States takes the most brilliant engineers they have, and they spend all their time working on strategies to pick other people's pockets, as opposed to producing and building real products.
This is crucial that we understand this. From the point of view of a big bank, a really big bank, you're getting free money from the government via the Federal Reserve, and then you're big enough to actually manipulate the markets, which makes your proprietary trading desk incredibly profitable, because you can make something happen and bet on it and make almost risk-free money. And then if it blows up in your face, as it might every once in a while, even when you're controlling the markets to an extent, the government is standing there willing to bail you out, because for you to blow up, they perceive it would be a global catastrophe. So you're operating for your own account with almost zero risk. The absolute worst case scenario for the guys running these banks is that they run into some trouble and the head guys have to leave, but they leave with massive bonuses. They leave being able to keep prior year's bonuses, so that they leave rich. And that's the worst case scenario for them, is that they have to go off and hang out on their yachts for a while and count their hundreds of millions of dollars that they've made. And that's it. So this is the quintessential moral hazard now. These guys can control markets using free money to speculate for their own accounts with absolutely no real downside. Do you think the guy who ran Citigroup, or the one who ran Merrill Lynch into the ground, are suffering right now? They probably have $100 million in the bank. Wherever they are, they're extremely rich. And so there was no downside for them. They made some of the biggest corporate blunders in human history, and they walked away rich. And that's the situation for these guys right now.
If you look at the 10K and 10Q of all of the major investment banks, Morgan Stanley, Goldman Sachs, from their trading standpoint, they have profit days versus loss days that are so out of line with that even casinos don't have that kind of win ratios. And if you look at them on a quarter, they're lucky if they have 1 or 2 or worst case 3 days in which they actually lose money, and those days are minor against profits on any other day. I mean, the statistical chance of doing that is beyond imagination. So what they've done is they've now put themselves into a no-risk investments, the way they're controlling, tying things together, that is in a proprietary manner. So they don't have to take risks. That's the point I'm making here, John, to any extent. So why would they take risk on putting capital at risk in terms of an enterprise that may or may not make final products that will be beat competitively? So it's all, again, on the bottom line. And that's the game that we have. It's like John Adams' invisible hand. We put ourselves now, and we've defined a system that's feeding on itself and has actually put it into a death spiral, and it's getting tighter and tighter without us fully understanding why.
Yeah, lending money to a factory must seem like such old-fashioned, high-risk activities.
They won't do it
right now, because compare it with what they can do with their trading desk. They can sell some silver futures contracts and push the paper price of silver, say 4 o'clock in the morning when the markets are incredibly thin. They push it below the 50-day moving average, which triggers a lot of sell orders from technical hedge funds that are just trading on momentum, which then pushes silver down even further. And then the banks come in and they buy up futures contracts or close out their shorts at this lower price and make a virtually risk-free profit. And they do this over and over again in dozens of different markets, because they have the power to move a lot of money in the short run. they can do this, as much as they want to, basically. And that's why most days are profitable days for these guys, because they're not betting on markets as much as they are manipulating markets. And they because of their size and because of the perception that everyone has to follow what they're doing because they're the biggest in the market, they're able to do this over and over again. And like you said, make essentially risk-free money forever.
From the United States' standpoint, we have to compete in our export imports on value-added products, and we have to be very high up the value screen. We can't fight on price. That has traditionally been where the Asian markets have been. But, what we've done is we're now trying to, we put we're positioned where we won't invest in the kinds of capital and capex that it takes to really add more and more value at a cost-effective way of doing it. So it's allowing China now, who is moving very quickly up the value chain because it's getting the capital, the capex that's going in. I've got charts here that show the plummeting investment that's going on in capital expenses, whether for major corporations and in the small businesses that are just not formulating right now. And it's because they're basically being restricted from the capital markets, because the capital is being deployed in what is perceived a better fashion.
Yeah, it makes total sense. It's a weird kind of dichotomy now where you've got incredibly easy money for speculators and money that's still fairly tight for a small business that wants to start some kind of an innovative process that might be high risk but might be hugely rewarding if it works. Those guys have trouble getting money still at a time when interest rates are at historic lows. And if you're a speculator, especially if you're a big bank trading desk, you get unlimited funds essentially for free.
This leads to the whole area of unintended consequences. It's leading to dysfunctional markets, which is leading to overall instability right across the board.
All this money that's sloshing around out there in the world has various effects in various places. And for a lot of countries that are reasonably well run, it's actually a problem. What the U.S. is doing is exporting its own inflation. And for instance, in Switzerland, which is, the traditional safe haven, so much money is flowing in. And in part, this is because of the European crisis as well as U.S. financial mismanagement, but everybody wants to own Swiss franc denominated financial instruments now because they perceive it to be much safer than euros or dollars or whatever. And that's swamping Switzerland and causing the upward pressure on the Swiss franc, which is going to price their exporters out of global markets if they don't do something about it. So they've had to peg the Swiss franc to the euro, which means they're going to accept European levels or Eurozone levels of inflation going forward, which means they're going to debase the Swiss franc at an accelerating rate. And they perceive that they have no choice. And if it goes any further, they're now threatening massively negative interest rates. In other words, you got to pay the Swiss to hold onto your money, and capital controls in which they just by law, limit the amount of money that's allowed to flow into the country. And these are huge distortions in the market, which is going to make Switzerland a lot less efficient and a lot less good at what they do over time. And they see that they have no choice but to take these steps because the alternative is to just be swamped by all this money coming in. Same thing with Brazil. They're a reasonably well-run country. And their reward for that is that money from all over the world has been flowing in for the last few years, pushing up the value of the real and threatening to price their exporters out of the global markets. And they're having to thrash around and impose various kinds of capital controls. And then when it works too well, they have to pull them off because they start to fall into a recession. And now it's happening again. And so their government is out there calling it what it is, a currency war, and claiming that they're victims of it and threatening even more draconian kinds of capital controls if the U.S. and Europe don't get their acts together. And there doesn't seem to be any solution for these smaller countries because the monetary and fiscal policy are basically fixed for the U.S. and the Eurozone. We're going to do what we're going to do, and that is we're going to debase our currencies because that's the only way we can survive, in our opinion, under the current system. And so the rest of these guys are just going to be collateral damage, and that's all there is to it. Ben Bernanke made a speech the other day where he basically said that. He said, you guys are just going to have to accept that our monetary policy is what it is, and you're going to have to adapt. And maybe you're going to have to let your currencies go up in value. In other words, you're going to have to pay the price for our mismanagement. And, we're big enough to feel like we can get away with that for a while. But that's not true. Other countries have options, and they're starting to exercise those options. And the consequences for the value of the dollar and the euro are going to be very severe in the very near future.
Yeah, I think he threw down the gauntlet. I know how China and Russia and Brazil and other countries who are in this competitive devaluation situation, we have this race to debase, a race to the bottom. They know what it means, and they have strategies around it. And another section we're going to talk about what's unfolding here regarding the petrodollar specifically, of how they're going to really end run this whole United States dollar as the world's reserve currency over a period of time without destroying themselves in the interim. John, we're up against our hard line as always, but in kind of tying this together from a regional standpoint, we really have monetary malpractice that's causing a whole series of other kinds of problems. And you kind of listed a number of them I thought we should touch on before we finish. Basically,
when you borrow too much money as a society, history shows that there's really only one solution that works, and that is take the pain now. Let the debt be wiped out. Let it be gotten over with as quickly as possible, and then start fresh with a clean balance sheet. And, in the past, during the gold standard that ended in basically 1914 with the beginning of World War I, there were frequent quote-unquote depressions, but they were fast. There would be a crash. 2 years later, things would start growing again. It would be a hard 2 years, but we got the excessive debt out of the system. And since the creation of the Federal Reserve, and especially since we cut the dollar off of any dependence on gold in 1971, we've been operating on a very different strategy, and that is just to prevent any kind of a crash from happening. Even when we build up too much debt, we bail everybody out. And so the amount of debt in the system has gone up and up and up. And so we're creating conditions sort of like in America's national forests, where we tried to prevent forest fires for 30 years, and then we end up with even bigger forest fires because there's so much underbrush that really burns hot and out of control. And that's happened with debt now. In Europe, they're not allowing the peripheral countries to eliminate their debt. They're bailing them out. In the U.S., we've bailed out the big banks. We're bailing out state and local governments to an extent, and so we're creating conditions for a bigger more catastrophic collapse when the time comes. And that's, as you called it, monetary malpractice. That's exactly what it is. We're running our monetary systems in a really dysfunctional way, and we'll pay a price for it somewhere down the road.
Thursday was the 25th anniversary of the market collapse. It collapsed because of something called portfolio insurance, which was the front running of dynamic hedging, which was basically a put. And everybody thought they were protected on the downside. And so what we had so much risk mispriced that when it collapsed, it was the biggest stock market collapse that we had seen since 1929. Well, I would argue that today, John, what we have is the Bernanke put, and it's doing exactly the same thing here with this extended Q quantitative easing and built on the Greenspan put. But we have, again, got such a disconnect in pricing of risk in the market, that when we have, and we are going to have a market clearing event, I don't know when it's going to be, but sometime in the next 18 months, some event, because of the magnitude of mispricing, malinvestment that's now running, will need to correct. We're seeing that with non-performing loans just absolutely going crazy, whether it's Spanish real estate, whether it's the student loans, whether it's HELOCs. It doesn't make any difference, which is what forces this to happen. You can extend and pretend for only so long. But it's really monetary malpractice that we have here. But of trying to, forcing itself to do it, frankly, because of the amount of the size of the global debt structure.
Yeah, agreed. Something serious is coming because we're building up so much malinvestment out there. And, the timing is really the issue because we've been able to keep this going for so much longer than seemed reasonable back in the middle of the last decade. And so because a printing press is such a great tool for fooling people, it's conceivable that we can keep it going for a lot longer. But as you said, in the next 18 months, it's also very, very possible that something comes to a head. One of these things will blow up out there and cause a cascade failure of the other things, and then lead governments to react in extreme ways, one way or another, and then we get chaos.
You can see it coming, and Lenin said it. He says there are decades where nothing happens, and then there are weeks where decades happen, and this will go on as it's doing. But when it happens, it'll be very abrupt and very sudden and come out of nowhere. John, on the other night I was doing some analysis of what's funding the U.S. debt right now, and it's been basically the Federal Reserve printing money. But the only buyer has not been China. It's been moving up, but it's been the UK and Japan. And now with the debt even being larger, then I'm looking at Japan and the magnitude of debt it has. How does it buy the amount of debt that it's buying to keep the U.S. government going when it, in fact, is the world's biggest debtor? And I guess I leave that to our listeners of this giant Ponzi scheme that will go on. But like on Madoff, when it happens, it suddenly happens, and everybody who thought they had a great investment suddenly realized that it was totally mispriced. John, concluding comments here for this week?
No, we've covered this batch really well, Gordon. We can leave it there as far as I'm concerned.
Thank you very much, John.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.